Good morning, everyone. Sorry for the delay here. We've had some technical difficulties with technology, as you all know. I'm not very technologically inclined, and something goes wrong, we have to get our IT department, so thank goodness for them. So at this point, we will get everything going. I just want to wish everyone a Happy New Year. For those listening in Ontario, I hope you're finding ways to keep warm. I heard yesterday that with the cold weather we've had so far in December and January, if we get even average February temperature, we will have the second coldest winter in Toronto in 25 years. And I'd have to admit, I have to vouch for that. One of the casualties of this cold weather today is Gareth Watson, who is at home today with a bout of the flu. But we are fortunate and grateful enough to have Craig Basinger filling in for Gareth. And I'll let you know exactly who Craig is in a little bit. We'll just review the markets in 2013. We experienced the other end of the spectrum with the equity market in 2013 were scorching hot. 2013 was a busy year overall. The 10-year government bonds went from 1.5 to almost 3%. That may not seem like a large increase in real terms, but that increase equals about 100%. This was based on the U.S. Fed Chairman Ben Bernanke hinting at tapering their bond buying program. This had a negative effect on pretty much every area from bonds to all equities around the world. He turned around a couple of weeks later and stated he may not taper after all, and the equity markets rebounded and celebrated the news by going higher in the upcoming weeks and months of 2013 after that announcement. In November, the Feds actually tapered and reduced their bond buying program by $10 billion, and this time the equity markets embraced this news and went higher. In 2013, the U.S. government also shut down for 16 days in October. In our presentation last year at this time, our view was that the bond market would have a difficult year and that the TSX would provide okay returns, but the U.S. equity markets would fare much better. Based on this outlook, we were underweight our fixed income, target weight Canada, and overweight U.S. equity. Fast forward to the end of the year, we weren't too far off in our views. As you can see in this chart, the S&P TSX Composite Index was up about 10%. The S&P 500 was up 38%. These are all in U.S. currency, so they're the actual returns for Canadian investors. The MSCI Europe, Australia, Far East Index was up 28%. The emerging markets were up a measly 2% in 2013. The DEX bond universe was down 1.19% last year, and gold was down 23%. So now here we are a year later, and we're going to go through all the noise, and we will be providing you our outlook for 2014. I want to now hand it over to Craig Basinger, who is our Chief Investment Officer and Portfolio Manager. Thanks again to Craig for stepping in. Just a little bit of background about Craig. He was with Richardson GMP, and then with the acquisition of Macquarie by our firm, he's now back at the helm as our Chief Investment Officer. So, Craig, welcome back. For those of you, you've probably heard him speak before, and just like Gareth, he's a regular guest on BNN, and all the national publications come to Craig and his team to get insights on what they think of the market and the economy. So I'm going to hand it over to Craig. Thanks again, Craig.
Thanks, Frank, and good morning, everybody. It is, yes, I've clearly come full circle all the way back to my old partners at Richardson GMP. I couldn't be happier about it, to be honest. It's a fabulous organization that's really grown a lot since I left in 2007. So 2014, I think I want to start off by saying that, well, all of our views on 2013 were relatively constructive in the sense that, as Frank's highlighting, a little bit negative on the bond side, a little bit kind of neutral, or a little bit worried with the Canadian equity market, but not too bad, and bullish on the U.S. market, and that clearly is the way things spelled out. But I think the safest assumption is this year probably won't be nearly as bullish, because it's really hard to put two back-to-back 32 or 38% years in the U.S. market once you factor in the currency. But we are still relatively constructive, and in fact, what we're calling our market outlook for 2014 was welcome to the second half of the recovery, and it really comes down to an aspect of confidence. And you know, if you go back sort of 4 or 5 years, we were in a number of years where even past the recession, even coming out of the recession on the recovery, we were in a number of years where confidence was significantly lacking in the market, and this was clearly evident when a European crisis would flare up and or the U.S. would run into its debt ceiling, and or the economic data would slow down, and what you'd have is a pretty negative reaction in the equity markets. You know, fast forward up to last year, and that's the year that we believe the confidence returned. We're seeing an environment that is much more resilient to the bad news, and that's a pretty constructive environment. And I think it's, I think it's been helped by the fact that, one, the financial crisis is now 5 years in the rear view, which, so it starts, the memories start becoming a little less vivid or a little less fresh. And as with everything, time heals wounds. And the other aspects are, the U.S. housing is recovering, unemployment continues to grind higher. Not a fast recovery, but certainly it seems to be gaining momentum. So we view this as we're now in the second half of the recovery. And so what does that hold for us in general? And before I get into sort of some of the more specific markets, generally an environment that is less volatile. Now, unfortunately, that probably means since 2013 was the good kind of volatility, the kind that goes up. Probably a little bit less from that perspective as far as robustness, but more sustainable and less volatile and a little bit more encouraging and a little bit more constructive on the investment side. So we're pretty excited heading into 2014. There are a few hiccups and a few concerns that I'll touch on near the end of the presentation. But yeah, let's jump into who do we care about. And Europe was all the rage. Everybody talked about Europe, and we all became experts on Europe because they had a financial crisis. I guess that's sort of the way it goes in our business. But the fact is it's a monetary union without a fiscal union, and that's problematic. And I think they've realized the problems within that structure, and it still certainly remains an issue, even though they have come a long way in solidifying or bringing the fiscal part of the union closer together. But right now, with decent economic growth, or them starting to show economic growth, again, it sort of goes into the rear view. It's still certainly a problem. It'll become a problem if we run into another recession and or strains on the financial system, and it could flare up again. But for now, decent economic growth coming out of sort of a bit of a double-dip recession over there, pretty constructive, and unemployment is still pretty high. So, there's no excess in the system. So it's not a bad place right now, and valuations are a little bit more constructive in Europe. That being said, I still think they have a long way to go to sort of bring their union into a more robust state that can weather storms ahead. But for now, it's certainly not one of the things that we're concerned about heading into 2014.
And one quick question there. I've heard others say that Europe is somewhat where the U.S. was 3 years ago. What's your view on that?
Maybe from a valuation perspective, absolutely, because they're certainly closer to the trough than the U.S. is after sort of 4 or 5 years of gradual recovery. And I still think they have some structural issues that make it a little bit less robust than the U.S. market. So even though valuations have become more expensive in the U.S., we're still pretty constructive on that market over others. But I think internationally, we're much bigger fans of the developed markets, so that would include Europe and the U.S. over emerging.
Okay, great.
So yeah, the next slide is just sort of highlighting, and this is just the 10-year European bond yields, and they've certainly come down and stabilized over the last year, which I think is creating a fair bit of calmness in the environment, and certainly some of the help from their central banks. But again, the stresses just don't seem to be there at the moment. So switching to the next slide on the Japan experiment, we'll call it an experiment because they're taking monetary policy to the next level in the sense as far as how much stimulus they're trying to push into their economy. And, at the end of the day, it's been pretty positive for the economy in fostering growth, which is a positive thing. It certainly could be causing some issues down the road, but again, this is the first time they've sort of injected a little bit of inflation, a little bit of economic growth into the system, and I think if Asia continues to weather, continues to grow, it'll be a much more decent place. We're not investors in Japan. To be honest, I don't know enough about it as a portfolio manager to say run out and buy Japan. But again, for internationally diversified developed markets, I wouldn't be against having some exposure.
What do you look out for in Japan with respect to the contagion, both positive and negative, let's say, that will affect other countries based on what happens in Japan. I've heard